Quantifying your system's performance is a challenge that every retail trader faces. Dr. Van Tharp developed the System Quality Number, or SQN, as a simple method to rank trading systems. Here I'll explain the SQN's calculations, as well as some of its benefits and drawbacks. Before discussing the SQN and its uses, we first need to understand R multiples and R expectancy. All profits and losses, which should include your transaction costs, should be related to your initial trade risk, R. For example, if you decide to risk $100 but end up losing $200, your trade's R multiple is minus 2R. If you risk the same amount but instead have a $500 profit, your R multiple is plus 5R. Ideally, your losses should be no more than minus 1R. If you trade an illiquid market, slippage can often make you lose more than expected. With the R multiple of each trade calculated, you can then calculate your system's R expectancy. This is the average R multiple across all the trades in your backtest. Here I calculate the R expectancy of a hypothetical system with 5 trades. If you don't know your trade risk beforehand, for instance if you use an indicator-based exit, you should use your backtest's average loss as 1R. Here's the formula for the SQN. It is the ratio between the R expectancy and its standard deviation, multiplied by the square root of your number of trades. Dr. Tharp provides the following benchmarks based on a sample size of 100 trades. For most systems, you'll probably get an SQN between 1 and 5. This particular sample size of 100 is important. I'll come back to it when discussing the limitations of the SQN. MT4 doesn't compute the SQN, so you'll need to do some quick Excel work. Let's do it with a 15-minute pound-yen strategy that was backtested from 2003 to 2021. First, export your backtest report from MT4 and open it in Excel. After removing all rows with an empty profit value, add a column to calculate the R multiple for each trade. I'll divide each trade's profit or loss by the average losing trade. Now you can calculate the R expectancy and the standard deviation of the R multiples. Finally, using your number of trades and the formula above, you can obtain this system's SQN of 3.85. If you use Quant Analyzer or StrategyQuant, the SQN is automatically calculated. The SQN is effective in the following areas. The expectancy measures your system's profitability, while the standard deviation measures consistency. If your individual R multiples are closely clustered around the expectancy, your standard deviation will be low, improving your SQN. A large backtest sample size improves the statistical significance and reliability of your metrics. And since the SQN is proportional to the root of your sample size, this will be reflected in the higher SQN. Now for some limitations. Dr. Tharp mentions that a large sample size can overestimate the quality of your system. To overcome this, he proposes the following. If you have fewer than 100 trades, simply use the standard SQN formula mentioned earlier. If you have over 100 trades, multiply the ratio between the R expectancy and the standard deviation by 10. This assumes you have only 100 trades. If you're an algorithmic trader with a multi-year backtest, chances are the second point applies to you. Depending on your sample size, this approach can be too conservative for many. I will illustrate this using the system above, which produces a SQN of 3.85 after about 1200 trades. Here's how the system's SQN varies as sample size increases. If I use the sample size of 100 instead, the SQN plummets to 1.13. Using Dr. Tharp's benchmark table shown earlier, this has transformed the system from excellent to average. So if you have a long-term backtest like the one above, you will probably overestimate your system's quality. And if you artificially cap your sample size at 100, your system will become almost untradeable. In addition, capping your sample size will penalize systems that trade more frequently. Such systems are generally more efficient in making money, which is everybody's ultimate aim in trading. Personally, the large impact of sample size on the SQN lowers its credibility. A system's quality should not be affected by sample size. You are testing the same system after all. A large sample size only serves to make your metrics more reliable. It makes more sense to apply the SQN when doing manual backtesting or forward testing, where sample sizes are generally well below 100. Secondly, large winners can have a negative impact on your SQN. Recall that the SQN is inversely proportional to the standard deviation of your R multiples, which measures the consistency of your individual trades. A handful of abnormally large trade results will increase the standard deviation value, lowering your SQN. Large losers will rightfully lower your SQN, but unfortunately, large winners have the same effect. A large winner will increase the standard deviation more than it increases R expectancy. This can be problematic if you are evaluating a trend-following system, which usually contains the occasional large winner. These large winners create fat-tail trade distributions, which often make trend following profitable in the long run. I prefer a metric that doesn't penalize upside volatility. To focus on downside volatility, you can amend the SQN formula to only include the standard deviation of losing trades. This is similar to how the Sortino ratio improves upon the Sharpe ratio. Personally, I do not use the SQN because of the drawbacks mentioned above, but that doesn't mean it can't work for you. Here are two great ways to use the SQN. You can rank systems with roughly the same number of trades, or you can remove its reliance on sample size and simply compare the ratio of expectancy over standard deviation. You can also use the SQN for parameter optimization for a particular system. In general, every metric and every approach in trading has its own limitations. As traders, we need to understand what these limitations are and find ways to circumvent them. I recommend concurrently using several metrics to get a more comprehensive assessment of your performance. Here are some other simple metrics that you can consider. I've made a separate video on what the Alsa index is. You can find it at the link at the top right. And most importantly, have a look at your equity curve, because sometimes a picture does speak 1,000 words. If you'd like to learn more about the SQN, I recommend reading Van Tharp's Definitive Guide to Position Sizing. Are you a fan of Van Tharp's SQN? Let me know in the comments, and don't forget to subscribe.